What is share repurchase, and why do companies do share buybacks? A share repurchase, also known as a stock buyback, is when a company buys back its own shares from the market. This reduces the number of shares available for trading and can have significant financial and strategic implications for both the company and its shareholders. But why do companies choose to execute share buybacks? Let's explore the key reasons. There are about 7. Increase earnings. Per share EPS. One of the most common reasons for a buyback is to improve the company's earnings per share, EPS. By reducing the total number of shares outstanding, the company's net income is divided among fewer shares, effectively boosting the EPS. This increase often makes the company appear more profitable, potentially attracting more investors and driving up the stock price. Signal confidence in the business. Buybacks can signal that the company's management believes the stock is undervalued. By purchasing its shares, the company demonstrates confidence in its financial health and future prospects. This can reassure investors and improve market sentiment. Return excess cash to shareholders. Companies with excess cash and limited opportunities for profitable reinvestment may opt for a buyback as an alternative to paying dividends. This approach allows them to return capital to shareholders while giving investors the flexibility to sell their shares or retain them to benefit from future growth. Optimize capital structure. A share buyback can help companies achieve an optimal balance between equity and debt in their capital structure. By repurchasing shares, companies reduce equity and in some cases may take on more debt to finance the buyback, potentially increasing their return on equity, ROE. Fend off hostile takeovers. Share repurchases can reduce the number of shares available on the open market, making it harder for potential acquirers to gain control of the company through a hostile takeover. This strategic use of buybacks can help management retain control. Offset share dilution. Share buybacks are often used to counteract the dilutive effect of issuing new shares, such as those issued for employee stock option plans or acquisitions. By buying back shares, companies can maintain the same level of ownership for existing shareholders. Tax efficiency for shareholders. Now, unlike dividends, which are immediately taxable as income for shareholders, buybacks allow investors to choose when and how they want to realize the gains. This can provide a more tax-efficient way to return value to shareholders. Share repurchases are a versatile financial tool that companies use for various strategic purposes, from improving financial metrics to signaling confidence in their future. However, like any financial decision, buybacks have their pros and cons. While they can enhance shareholder value and optimize capital allocation, they may also raise concerns about the company's long-term growth strategy if funds are diverted from reinvestment opportunities. Do you have any question? Direct them to the comments. Thanks for watching. Kindly subscribe to our platform.